Hi, this is Bryce Knorr, Senior Editor of Farm Futures Magazine, and welcome to The Buzz for Thursday, October 25th, 2012. The grain market seems to be as variable as the weather lately, one day hot, cold the next. I'll try to help you sort out this confusing situation and what it could mean for prices. Soybeans have seen the greatest churning. As the week started, it looked like prices might be ready to head south for another test of $15 following Friday's bearish reversal lower. But then the market turned around, moving to the highest level since the first of the month. November futures moved above its 100-day moving average, raising hopes the market was ready to confirm a bottom and make a run back to 16 bucks. But a somewhat perplexing export sales report this morning turned futures lower. While the total for the week was only 100,000 bushels below last week, it was less than the trade anticipated. And despite USDA's later announcement of another big sale to unknown destinations, traders appear to be focusing on news that 3 of China's earlier purchases, totaling 6.6 million bushels, had been shifted to Thailand and Taiwan. January crush margins are negative in China, and the switches raised fears that Chinese demand could be easing after record purchases this summer. Of course, Chinese demand is going to have to end at some point this year, lest the U.S. run out of soybeans. Already, China has purchased or shipped 565 million bushels, almost 45% of the entire USDA forecast for the marketing year for all buyers. China accounted for 63% of 2011 U.S. exports and is close to that market share this year. The question is whether China will keep buying at a steady clip or wait for South American supplies to hit the market this winter. Right now, USDA's forecast looks too low unless China squeezes other buyers out of the market completely. If China does get in a bidding war, it could easily move the market back above 17. If not, futures could be stopped by resistance around 1630 to 1640. Rainfall is also a big topic this time of year as regards South America. It's been a story of either too little or too much. Heavy rains are delaying corn planting in Argentina, which could lead to more soybean acres there. Flooding could also be a problem in southern Brazil, and more rain is expected into next week in both areas. To the north in Brazil, there's been less precipitation. Rains are starting to work into these areas, with the second week of the 2-week forecast looking very wet. The importance of South America was just one factor weighing on the corn market. Mexico switched an optional origin purchase of 10.6 million bushels to non-U.S. origin, which followed news that Mexico had improved imports from South America. Much of the visible rationing in the U.S. corn market has taken place with exports, which slowed to a trickle recently. Today's report totaled just 5.6 million bushels. Over the past 6 weeks, sales have averaged just 5 million bushels a week. As a result, total corn sales and shipments have fallen to their lowest level since 1987. Ethanol demand did pick up a little this week, but news out of the livestock sector continues to suggest large cutbacks there. That's kept the futures market very quiet. Futures broke below a short-term wedge on Thursday, suggesting the market could be headed towards another test of support around 732. Fortunately, the trend in the cash market is making up some of this lost ground, at least in the western corn belt, where bases continued to strengthen this week. I've continued to recommend incremental sales of remaining inventory using hedge-to-arrive contracts, with the goal of trying to equal the revenue protection harvest price, which is based on the average for October. That average stood at $7.52 going into Thursday's session. Corn still looks like it has upside, but much of the upside may come, like last year, in the cash market. Get ready to consider using weakness to pursue option strategies. Watch our daily recommendations in Farm Futures Daily for specifics. The wheat market also appeared on the verge of a breakout to the upside this week, with prices at all 3 exchanges above moving average support and breaking through trend lines drawn off September and October highs. But prices couldn't sustain the move to the top of the summer and fall channels, which is where I recommend starting to wrap up old crop sales. The spark behind this week's move came from the farm minister from Ukraine, who repeated the country will ban exports November 15th. With Russian supplies running out, that left only wheat from Europe to compete with the U.S. for the lucrative market in North Africa and the Middle East, at least until new crop hits the pipeline from the Southern Hemisphere. U.S. sales in the first half of the 2012 crop marketing year are at 3-year lows, even though USDA forecasts an increase over last year. Still, export sales were good in the latest week, topping 21 million bushels, even though the business was with our regular clientele base. While I still think wrapping up old crop sales is a good idea, the hard red winter wheat crop on the northern half of the plains remains under the gun. Emergence is slow and the crop is likely to go into dormancy poorly established there. But getting the market to rally on those concerns likely won't happen until 2013. Well, that's all for this week. I'll be back next time with a preview of the November USDA crop report on the next edition of The Buzz.